Hello, everyone, and welcome back to the Rodcast. It's been a while, I think almost 12 months since our last mastermind, so we've got a bit of making up to do. But I am joined once again by Adam Lawrence and Manish Kataria, where we are doing our special quarterly mastermind. The idea of this episode is that we each pick a investment that anyone can buy out there, and we explain the rationale for our pick, and then we open it up to the others to critique or agree. So before we get to our picks, Manish and Adam, it's been a while, like I said, and that's totally my fault. But should we have a bit of a rundown because an awful lot has been going on in the last 12 months? So, I mean, I think let's run through what we feel has been going on. Adam, do you wanna start us off, and then we'll go to Manish?
Very, very happy to. Yeah, of course. I mean, nothing really, Rod. It's all been fine, hasn't it, to be honest? So we've obviously had I think it certainly surprised me, or it certainly caught me a little bit off guard when Mr. Trump decided to support Mr. Netanyahu into bombing Iran in very late Feb. Obviously, first order impact was oil prices shooting up. I think we saw about 140 a barrel very briefly. Lots of talk of global economic crash, as there always is, but no one remembering that when we went to 148 a barrel or 147 in 2008, that was 2008 prices, not 2026 prices. So I think we'd have needed about 250 a barrel to be at that sort of equivalent. Gilt yield shot up. Everybody gave up on the Bank of England cutting rates in that interim period. Actually, things looked pretty ropey for a few weeks in sort of March, April. There was that sort of initial period where we hoovered up all of the remaining mortgage money that was on the table, if you like, at the old, slightly cheaper rates. Then we had some nasty times where maybe 6.5% was the best sort of thing we were being quoted. We've now been semi back to normal or elevated normal. Elevated inflation a little bit. We missed that 2% we were promised in April, although I never believed that anyway, to be honest with you. And the job market is still fairly ropey, unemployment clinging on by its fingernails. And then we've got one of these new prime ministers, but that's hardly even news these days, is it? Because I think it's rather than the old seventh one in 10 years, I think it's more important that it's the fifth one since 2022. That's kind of crazy, isn't it? But I won't that I'll leave the rest for Manish to sweep up.
I think you've said it all, actually, Adam. Yeah, look, as far as stocks are concerned, we call all of these events, we call that climbing a wall of worry. And there's always something around the corner, right? And particularly when you've got Trump in charge of the US, there's always something. You can guarantee there'll be at least one big thing a year. Last year we had the tariffs, and this year we've had the Iran war, and who knows what else. But markets, do they climb a wall of worry? I can't. I didn't realize we hadn't met for 12 months. It's That's a long time, but yeah, there's lots been going on, and yeah, so I think Adam's highlighted most of them, and I think
I'll tell you what I left for you. How about the world's first trillionaire and
yeah,
SpaceX?
yeah. Well, that's exactly what I was about to come on to. We've had, SpaceX, which IPO'd recently, and all that hype that went along with that. And, we've kind of come full circle, right? So SpaceX had a great listing, as most people expected, because Wall Street was well behind it. Wall Street, it was in the US bank's interest to make it, get off to a good start because they're getting fat fees from all of that. I think they've made something like $500 million out of the SpaceX listing, just on the listing fees alone, and then never mind all the trading fees that come along with it. So we're probably looking at about a billion dollars. And what's interesting now is right now the US banks are, they're listing all their results, their quarterly results. And they're all at record revenues and profits, as you might expect. The US banks' share prices are going through the roof. And a lot of this is down to SpaceX. A lot of it is down to the hype. So we've had that, and actually at the time of speaking, SpaceX has come all the way back down to listing price.
Back down to earth.
Back
Really.
down to earth.
He's here all week, folks. He's here all week.
And obviously we all know each other because we've got a bit of a background in housing and property investment. Um, do we want to run through what's been going on from the property point of view as well? I know from my point of view, London's had a tough time, and it might surprise you what my pick is today based on that. But yeah, it's not just kind of this war going on, which certainly hasn't helped gilt rates, but it's also things like affordability, tax, stamp duties really biting people, the non-dom stuff as well. We're starting to see a lot of sort of those families move out. There is a supply and demand problem where the demand is not there. So typically where we've had development going on in previous years, those developers develop because they've got demand to buy the end product. And normally that's in the form of buy-to-let investors, whether they're homegrown from the UK or abroad is a completely different measure. But what we're now seeing is that those developers cannot sell 30% upfront to buy-to-let investors. And so investment into development, especially around London, has just fallen off a cliff. I mean, we're at our worst year, I think, on record. And so it's
4,170 units last year in the whole of London. I mean,
it's it's awful.
unthinkable.
Yeah, and so London is really, really having a difficult time of it. But I guess we'll talk a bit more about that maybe on one of my picks. But Adam, do you want to talk about kind of the rest of the market as well in terms of property?
Absolutely, Rod. Very happy to. Yeah, I mean, look, we've had this sort of glut of stock that's been probably 2 years in the making, really. I think a lot of people took cover during the pandemic. They still had stuff on cheap mortgages. About middle of 2024, people started to put their heads above the parapet and say, maybe it's time to sell. You know, the election, Labour getting in, they knew the renters' rights thing was going to happen. Tons of landlords trying to sell stock, not necessarily successfully, perhaps reletting it. Some that are selling have been selling to corporates, of course. Some have been selling to first-time buyers, but average, available rental stock is down, but not dramatically. Rod,
But also now, if those kind of landlords want to sell, they've got a slight problem because you then can't put it back on the market for another 12 months to rent. So if you sell now, and bear in mind for the last sort of 3 months, we've had something like 60% that's gone on the market has not sold. So it's a massive gamble to sell because if you're not going to get the price you need, you're screwed in another way because you then can't rent it out for 12 months.
certainly to evict to sell is a
Yeah.
massive gamble. Absolutely. How well will that be policed, my friend? Well, that is a whole new podcast, isn't it, realistically? But as usual, the people who are more, either law abiding or nervy or a bit of both will follow the rules. So the other thing I've been hearing is that rentals are struggling in London as well. So if you've tried to sell something in London and then you're then trying to let it, you're sort of scuppered at every turn, really, which can only mean one thing, Rod, and that must mean deals. And I'm hearing a couple of people in my network who like London, who think, it's 10 years, it hasn't moved a lot and stuff like that. They're buying, but they do sound like they're buying very, very well. But still, that stamp duty they've got to pay is painful. And it's all cash. You're not leveraging that stamp duty. Like you said, it just gums things up. But maybe our great savior, Mr. Burnham, and his land value tax will sort that out, guys. What do you reckon?
Well, I'm not as opposed. It just depends on some of the finer details of it. I mean, in theory, I don't mind it because I feel it pushes up transactions, right?
I agree.
And
I
I
agree.
think what we need from a housing market is lots of transactions rather than kind of pricing. Um, but that depends on some of the finer details of how it's kind of brought about, especially with the landlords having a surplus amount and all this kind of stuff. So, on the face of it, I'm okay with it, but we need to see kind of what those details are when the cap for the price kind of reduces. And also, if you put a tax on a value, a tax on wealth, which essentially is what it is, that's taxed every year. Well, what happens to the wealth? The value suddenly will drop. So if something as a tax, so suddenly values will drop. So again, there's some kind of there's a few intricacies into it, and we can't really. It's very difficult to comment on it until kind of they lay out what the plan would be, and then you can say, well, okay, that would work, or no, it wouldn't. So yeah, bit of a difficult one to comment on, really.
Good summary, though. Good summary.
Right, should we get on to our picks for this quarter?
Let's do it.
Manish, do you want to get us started?
Let's do that. I've got gold and silver. I've got two picks because essentially they both follow the same fundamentals. But one just happens to be a more leveraged version. So gold is, this sort of supposed to be the steady Eddie, and silver's the more leveraged version. And this is a revisit of gold. I did pick gold sometime last year, I think, and it did really well. I think gold had a sort of 50, 60% year in 2025. And now the reason I like it is because it's just come off. It's had a decent amount of profit taken this year, and it's sitting on a decent support level. So I've got a couple of charts which I can just show everyone what I mean, because this is a sort of visual thing that we need to just check. So let me share. If I share my slides, I've got just two or three slides I just want to share with people.
Perfect. So if you are listening to this, head on over to the YouTube channel, which is Rodcast Property, so you can see these slides. Okay.
I come through okay?
Yep, you should be able
All right.
to share it now with us,
Okay,
Manish.
perfect. Okay, so let me bring those up. So the first one I'm gonna bring up is a comparison between gold and silver, just to kind of show you what I mean, one being a more leveraged version of the other. So where are we? Here we go. Yeah, so the silver line is silver. This is going back 2 years. The silver line is silver. The silver line is silver. The gold line is gold, obviously. And so you can see the highs and the lows are much more leveraged for silver and gold. And you can see they had a huge run in 2025. I'll talk through the reasons why they did so well. I mean, gold was up 50, 60%. Silver was up much, much more than that. And you can see just in the last few months they've come off. And really. I mentioned too here because if somebody is willing to sort of be a little bit more adventurous, silver would be the one. And if you are, need a bit more of a sort of a steadier ride, gold would be your pick. Okay. And how gold really works, it works inversely versus the US dollar and also bond yields. But US dollar is the clearest to see. So you can see this going back 5 years, right? So this is when the blue line is the US dollar. It shot up around 2022 at the time when the Russia-Ukraine thing was kicking off, and gold actually declined during that period of time, right? You can see here over there. Then again, we had a similar episode just before the tariffs, and then we had the tariffs. And those tariffs led to everyone hating the dollar. The whole world was thinking, okay, the US is just pants. Let's get out of the US, right? The dollar sold off and everyone, was rushing to get their money out of the US because we were all thinking, well, Trump is just too much of a wild card. So the dollar sold off and gold just went on a massive run there, as you can see, right? So that's the inverse correlation. And actually, since Iran, since the Middle East conflict started, um, the dollar has actually strengthened, just a bit of a reversal, and that's why gold has declined since then. So that is hopefully you guys can see a
Yeah.
pretty a close inverse relationship between the two, right? So that's the background. But why do I like it now? Well, actually, I don't really have a strong view on the dollar because I think, look, the dollar has strengthened and we'll see where it goes from here. Um, the new Fed governor in the US is talking quite hawkishly, as in he's sounding quite firm on interest rates. That might support the dollar a bit, but I think a lot is priced in. But the reason I like gold right now and silver by extension is it's come off a long way, right? So we've had a bit of a good period of profit taking back from when it peaked earlier this year. And so I've shown this red line, and gold has actually bounced off that $4,000 per ounce level a few times. So back end of last year, you can see October, November time, and just again now, right? It's bounced off there two or three times, and it's right at that support level of $4,000 per ounce. So that's really what I'm hanging on to. The fact that it's come off a long way. I still think it's a great protection asset in your portfolio in case something bad was to happen. And the final thing, technically, from a support price level, 4,000 seems to be a good support level. Will it hold there? I mean, I hope so. There's no guarantee, but actually, it's found that support here. So it's a bit of a high risk play, right? So I'm not going to say it is guaranteed to hold at these levels. If it breaches it, then it might go through on a sort of more extended period of time. But I think if you're going to be buying it, if you wanted to buy it anyway, now is probably a good time to be looking at it. And the final thing I would say is that I often talk about options and this. If you were to own this with options, you could be paid to wait. So you could be paid about 2% a month to be waiting to wait for this to come back, to rebound at some point. So that's my pick. Gold, if you are a little bit more on the sort of balanced, cautious side, and silver if you're willing to, be a bit more adventurous at these levels.
So, Manish, what would have to happen for you to change your mind on this? What would be the signals you want to keep your eye on for then going, no, do you know what? I'm selling my gold, or I'm at least not purchasing any.
Yeah, good question. So I think the two main things, one I've talked about already, the US dollar. If the US dollar continues to strengthen, that, whatever you think of gold, gold will sell off, right? There is that very clear inverse correlation. And why would the US dollar keep going up? Well, if the new Fed governor, the Kevin Walsh, if he is really, really hawkish, continues to be hawkish, and he wants to raise interest rates and be at a departure from the rest of the world, then look, then the US dollar will keep strengthening in that environment, and if that happens, then gold will come down. So I think you need to be keeping an eye on the US dollar, keeping an eye on what the Fed governor is saying.
Mhm. Okay. Because I always worry about like when you're doing something because it correlates or negatively correlates with something else, because that's not the cause. But what you're saying is the causes that affect the dollar are going to be the same causes that affect the gold. Is that right?
Yeah, I mean, look, this is a long-term thing, right? So you can go take the chart back 50 years or longer, and you'll see a very similar pattern between that relationship has held quite strong historically. So there's no reason why I think it won't continue to hold strong. And there are real fundamentals, right? For example, bond yields, the reason why gold doesn't like higher bond yields is because there's an opportunity cost. A
Yeah.
cash buyer, they're forsaking higher interest rates in order to buy gold. So if those interest rates were going higher, there's more to lose out on, right? By owning gold because gold doesn't pay an income otherwise. So there is a real reason why that relationship holds.
And would it just be kind of the physical gold or silver you'd be looking at, or would you be looking at, say, an ETF, or would you be looking at
Mm.
mining stocks? How would you go
Yeah.
about actually buying it and getting exposure to it?
Yeah, I own most of my gold through ETFs because I think they're safer, they're a lower cost, there's no storage costs, and anything you buy through ETFs is FCA, FSCS protected. So there's no risk of any kind of issues related to fraud or anything like that. And the final thing is if you can do it through options, you can, ETFs, you can't do options on physical gold. You can do them on ETFs.
Okay, brilliant. Adam, any other points on that?
Well, I think I can't work Kevin Walsh out. I think Manish is probably in a good place here, and my pick kind of agrees with him, although it's a differing reasons and a different country and everything else. But it feels to me like Walsh is not going to be. Look, he's supposed to be a company man, right? He's Trump's boy. Okay. Trump, since the start, has said, I want 1% interest rates. Now, the governor of the Fed can't go in saying stuff like that. I don't like what he's doing in terms of less transparency. He doesn't give a dot for the dot plot and stuff like that. That's not cool. I don't think that helps the gilt yields very much. But this guy is a dove in hawk's clothing, folks, surely. So, as far as Manish's bet goes on that front, I like it from that perspective. I'm basing that on the fact that it seemed to me that it was a unspoken but clear strategy to weaken the dollar, to address the trade balance apart from anything else. And, you know, what are we, 19th month of Trump? It feels like 900, I know, folks, but that's where we are. And ultimately, they're still going on about tariffs. He's not going to give up on these tariffs until he gets something near something like what he wants. So I think the bet towards a weaker dollar is good. I think gold is pretty robust. I would personally go gold, not silver. Perhaps not daring enough on that front. I think it's a good hedge. And I think the other reason, in a slightly longer term macro kind of way, why it's a good hedge is because there could well be some demand destruction events around the corner here. So it's a pretty good piece of insurance if the global economy starts to stutter a little bit more, which a lot of people have been expecting since the Iran situation. And it's all sort of blown over. But like I said, there's a 12-month shadow here, Rod. So I like it. I like it.
On the demand destruction, I think there's another point which we kind of haven't really mentioned about the global economy, which is AI and entry-level jobs and that kind of stuff. And we've been talking about this kind of since AI really started. But now, I mean, kind of you've got everyone who is using AI now, probably daily. I mean, like I know we are. My wife will use Gemini, like things like that, and it's becoming pretty commonplace. And I do think at the moment we are starting to now see, again, it's showing up in the jobs market, it's showing up in unemployment figures and things like that.
Certainly for the graduates, right? And
Yeah,
the 16 to 24s in general. Yeah, yeah, yeah.
exactly. So I kind of do see that only getting a bit worse, really. Um, I don't know if you've got any thoughts on that from a demand destruction point of view and global kind of economics, but
Yeah, I mean, my feeling on that, and I'd be interested to see what Manish has got to say on that as well. But my feeling on that is that I'm overall a bull on this stuff in terms of what it creates in terms of value, jobs, opportunities, wealth, etc. But in the shorter term,
yeah.
the pace of change is so significant. And look, the shareholders love nothing more than a bit of a cost cut, Rod. This is the thing. And, share buybacks and all the rest of that sort of stuff. It's a tried and tested philosophy of the last 15 years. So we
But
cut
not just
costs
that,
first.
but not just that, it's also the cost of employment is so high with the national
Yeah.
insurance and minimum wage increases and all those kind of things that have happened sort of over the last 12 months. Um, that's a big thing as well. And so that adds to it. So it's the cost of employing
Hmm.
is becoming kind of
Well,
a,
and the
an
risk, right?
easier decision sometimes because
And
like
look, the risk in terms of the Employment Act and the changes to the rights that a lot of people feel. I mean, compare it to the US, has been said many times before, and we want to look after staff even more. I'm not convinced that some of these changes are necessary or value adding. Really, incentives and outcomes are not being aligned, really, Rod. So I get that.
so is AI just another magnifier like booze, drugs, and mortgages? So it's
It
just
is the way I use
amplifies
it.
what's already happened and a bigger divide between kind of haves and have-nots and all that kind of stuff.
That's a good analogy.
Hmm.
I'd certainly say so on the last point, absolutely, because what I'm seeing some people doing, and then I'm watching some other people who aren't using it at all, and I'm just thinking, my goodness me, in 12 months' time, your lives are going to look very, very different, in my opinion.
Hmm.
Manish, any
Yeah,
thoughts?
in the US, actually the jobs data is looking really solid. So the US is still adding jobs, right? So it's still adding sort of hundreds of thousands or about 100,000 jobs per month. So there's no evidence really that companies are shedding jobs en masse, right? So they're still net adding jobs. at the moment. So, the concerns for the longer term, yeah, look, and within the job market, you're right. Look, the younger, the graduates, and all the rest of it, there's a bit of an issue there. And hopefully, the hope is that these jobs that are being lost will be moved across to the new economy, the new AI economy, which is what happened
Yeah.
with the internet and everything else, right? So that's the real hope. But this
Yeah,
is
I think kind of Adam brought that point back, which is the shorter term issue. I think on the jobs market, it's all also you've got to look in context. So although jobs are going up, well, what is that like in terms of the population who are of working age and that kind of stuff? And
mm,
I don't know the
mm,
numbers for that, but I just think kind of sometimes a bit of context uh,
yeah.
can often be missing from these things.
There is anecdotally, I think it was yesterday, IBM lost 25%. Its share price dropped 25% because it's, a massive company, a stalwart like IBM, is losing massively to AI, and it's going to have to shed jobs. So, big employers are really feeling it right now, and at some point that will come through. But right now, the Capex spend, overall spend on AI is overshadowing any job losses.
Is that the consulting arm specifically that is getting hosed there, Manish, or what was the sort of context behind the 25%? That's a huge drop,
Yeah,
isn't it? I didn't know that.
yeah. I don't know what was behind it. I wasn't really following the details, but all I know is its latest revenue print was a massive disappointment on AI itself. So
Are
yeah,
they
I mean,
The Kodak of AI, basically. Is
mm,
that what we're looking at here?
quite possibly,
Right.
yeah, yeah.
Right.
Yeah, in fact, a lot of these software, these incumbent software providers, they've been under massive pressure because AI can, I've been doing some relatively deep research on Claude, and the stuff it comes up with, right? And just competing with Microsoft's Office package in itself, you don't necessarily need all that stuff. Just the results it's coming back with, I would have had to pay a consulting firm, tens of thousands for the sort of thing it's coming up with.
Yeah.
So
Yeah.
yeah, yeah, it's direct competition.
And that can only be, in my mind, a good thing for the price of gold and silver because it has this volatility in the shorter term. And when I say short term, I'm not talking about months. I'm a couple of years at least. Um, I would have thought, but yeah.
It's
Okay.
insurance anyway, in
Yeah.
case, as well as everything else, right? And so, the to protect you from the unknown unknowns as well. I think every portfolio needs some element of protection, and gold kind of gives you that. It does that job.
Hmm.
Yeah. Yeah.
Okay. Brilliant. Um, Adam, do you mind if I go next?
Not at all, please.
Okay. So, although at the beginning of the show I was telling you all how terrible the London property market is, um, I am going to pick Barratt Redrow, um, which is the house builder. Reason I'm picking it, I was kind of umming and ahhing over it for the last kind of week. And then they released some year-end trading updates this morning, actually. So it's fairly hot off the press. Um, and the big one that I kind of I heard a few weeks ago was that the value of their assets or their on winding up, let's say they wound up everything, the value of their assets is much higher than the share price. And so that piqued my interest. Now, when we talk about net asset values of certainly public companies, you've got to take it with a bit of a handful of salt, especially with housing and properties, because it's hard to calculate. And also, especially with Barratt Redrow, they merged sort of a year or so ago. And with that, so Barratt bought Redrow, and with that, you have a fair amount of goodwill baked into it because they've got their name, they've got kind of their operations and all that stuff. So actually, what we want to be looking at is the tangible net asset value. So, which is literally the add up all the land and properties and everything like that they'd sell, and you're getting rid of any of that goodwill stuff. And even that is currently sitting at 433 pence per share, but the share price is trading today at 287 pence per share. So that's, I don't know, about a 36% drop off that. So then we've got to go, okay, I mean, I'm the first person whenever I hear that go, yeah, but how are they calculating that asset value, even if it is just tangible? Is this on last year's figures? Is it on today's figures of what that property is? And I think this was my kind of biggest concern about it, is how they are pricing that on the balance sheet. Um, but actually, having looked into it, I'm okay on it. So I've got I've got few notes here. So essentially, they have increased their sales prices per property despite the market reducing by about 1%. Sorry, I've had someone come in here. There you go.
It's the old the doctor on the news and the South Korean. I remember it well.
There's just no one here to drag him out.
Shit, put him on.
What are your thoughts about Barratt and Redrow? Anyway, so sorry. Right. So the issue here is that they completed on, I think it was about 17,500 homes this year, which was pretty good because their guidance, I think, was slightly less than that, or this was around the top end of that. So they've done well. They forecasted completions of around 18,000 for next year, which again is pretty good. They've got about 300 million of problems in terms of legacy provision. So the issue they've got is these building safety and cladding costs. So there's about 300 million to come off that price, which is a concern. But there's recently been a landmark ruling, I think it was in May, at the Supreme Court, which basically said for all these building safety issues that Barratt have got to pay for, which again is around 300 million, they can now go after the subcontractors. So I know they've already clawed back 38 million from subcontractors. Now, how easy is it going to be for them to claw back all 300 million? No, they're not going to do that. But at least it means that that 300 billion is not kind of gone to the wind. So that was the other big concern I had as well, was these defects and that they were going to be kind of on the foot for. They've also got about 700 million in cash at the moment. With their the other concern of mine, which I kind of mentioned at the beginning, is London. I'm not that bullish on London, to be honest. And looking at where their current assets are and their current pipeline, most of it is in kind of regional areas, and they're not kind of going for like big apartment schemes or super high value. They're kind of in that mid-market range, which again is doing quite well. And my other issue was I looked into their average selling price rose by 2.3% despite prices falling. And I thought, well, how are they doing this? And it turns out that 21% of their of current private reservations that they've got in the last 12 months have been completed by part exchange. So essentially, they are saying someone wants to buy the house, which is a big problem at the moment. But in order to buy a house, they've got to sell their existing one. And a big chunk of their clientele who they sell to are sort of second, third movers. And so in the market at the moment, it's very difficult to sell. So if you can't sell your property, you can't then buy a new one from Barratt Redrow. And so 21% is a massive amount. It's a huge kind of portion of part exchanges. So I was thinking, well, hold on a minute. What are they doing with all these properties that they're buying off people? And how is that going on the balance sheet? I.e., is it going on at these inflated prices? And they've just got a load of second-hand properties now that they've got to sell, and they can't even sell these new ones. But they are buying them on an 8-week price or 8 to 10 week price. So essentially, they're doing the valuation as if they have to sell it within 10 weeks. So a bit of a fire sale, and they are paying those sort of prices. So that puts in a bit of a kind of bit of wiggle room on that, and they are selling these off pretty quickly. Um, so yeah, 772 million of cash they've currently got.
Mhm.
Yes, there's going to be a bit of money owed for some of these defects. Initially it was looking like it was going to be 300 million, but we can see now that they can claw back a lot of that off subcontractors. Trading at a discount of around 36% to their tangible asset value. And they've got a pretty big pipeline of around kind of 18,000 for next year. They're also, this is the other big one, are buying back over 350 million of shares over the next 12 months because they're realizing actually that their stock is low. Their share price is low compared to that. And so they're putting 350 million of their 770 million, whatever it was, of cash back into buying back shares. So that is, I think I've covered all the reasons why I like it. I've hopefully given you the reasons why I kind of had to think twice. And I think I'm satisfied with that. So I'd love to hear it. Any kind of comments or if you anything you think maybe worries you about it.
Yeah, can I go first? I think I like it because it feels like an asymmetric bet to the upside. We have a government that doesn't understand business. That's not going to change with the change of PM. But they do want to work. One thing Burnham has is form for triple P, right? Public-private partnerships. We already saw some big JVs announced by Rachel Reeves, but they're ultimately doing really badly on their housing targets, and they've got a terrible forecast for the next few years. We've got the biggest council housing boom in a generation or multiple generations, apparently, coming our way. Who's well positioned to build something like those as well? Let's face it. So I think there's a lot to like about it. And actually, the one thing you didn't say, but I would level the charge at you a little bit, is this a bet on help to buy being reintroduced? Of course, there will be a different name, buy to help or whatever we're going to call it. But what do you think about that? Because I think there's a good chance of that, certainly over the next two budgets, and that would have to help significantly in the share prices, wouldn't it?
Well, I think there's a few things that can help the share prices, and several of these things are being kind of mooted at the moment. We've already talked about a change in stamp duty, even if it is a land tax. But I think if that happens, that will help the share prices, regardless of these house
Because of
builders.
transaction numbers. Yeah, yeah,
Exactly.
yeah, 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 yeah,
Yeah.
yeah. Yeah.
And then also there's talk about like you say, a new help to buy. Um, look, I think we've got to look at why people are not buying, are not transacting at the moment, and what's the kind of what is it that's stopping them? And where you had kind of help to buy work really well in some places, especially kind of London, new build flats, that did great. Um, it again, it just depends on what it is. It's so hard to kind of comment on these things when you don't have kind of details of what they want to do. And so I do think they're going to need to do something to turbocharge transactions. They've got to because really the economy is so reliant on property.
It
And
makes a
so
lot of sense, doesn't it, as well, in
yeah,
terms of there is growth there just for increasing transactions. The only
exactly.
other thing we haven't mentioned in terms of news since we last spoke, really relevant news, I think, is the old home information pack or whatever we're going to call it these days, reintroduction, which would also help with transaction volume because they'd be faster. They're more likely to hold together. It makes the process a bit better. Look, I was going to, you got in first at the end of the day, Rod. I was going to pick a house builder ultimately. So I don't have a lot more to worry about on the downside. As soon as you mentioned you're buying it below liquidatable value, you had me at hello. Do you know what I mean? I'm all over it. So I like it.
I
I
think
like it.
the big issue, like I mentioned, is well, how do you come up with a liquidatable
Yeah,
value? And
yeah,
that's
sure.
really the big one because look, we can all say, oh, well, net asset values are this, but hold on. If then in next quarter they haven't sold any, then those net asset values are coming down and it's kind of
Granted,
meaningless.
granted.
So I did kind of have a little look at how they do the kind of net asset value
Rod, just to clarify, when they do a Part X, they're paying no stamp on that, are they, as well? So they can do these
yeah.
transactions with an element of profit, realistically.
Yeah, exactly. So there's so many benefits to these part exchange deals because when I saw it on the face of it, I thought, well, hold on, that's quite concerning. But actually, when you look into it, it's very clever.
Secondary market's doing better than primary market, so they're laughing, really, to be
Yeah,
honest.
yeah, exactly. Um, but yeah, I think when you use that tangible net asset value, you're stripping all the fluff out. You're just looking at the raw land, the half-built houses, and their cash pile. And even using that on kind of liquidation costs, which they're using from the last 12 months, which let's face it, is not great as well. So I think they've got a pretty good kind of margin of safety there. So yeah,
I think yeah, sometimes the net asset value calculation is a bit of a black box, right? But I think what you can be confident, I mean, or what you can use in this case is the fact that that discount, I think, did you mention
yeah,
36%?
yeah.
Yeah, 36%. You'd want to look at it historically, but that sounds like to me quite a historically large discount. And so even if you had some doubts about the calculation methodology, right? Because I remember looking at REITs back in 2022, and that was the sort of bottom of the REIT market because interest rates were really high. And some of these REITs, the sort of the big box REITs were trading at 40% discount to NAV, and that happened to be the floor, right? So that happened to be the worst it got. So if it's similar in this case, you could have some confidence that even if the methodology isn't great, you know, it's not going to get worse than this. So it's a bit of a value play. I also noticed its dividend yield is about 6%. So, you've got that dividend yield. It's doing share buybacks, as you said. It's net cash. I think you said net cash, right?
Yeah, yeah.
770s, including all the debt and everything.
Mhm.
So that's quite good. So I think all of, the value metrics all look like they are supportive of this. What I don't know, and this is probably a bit of a risk to be thinking about, is I don't know what the sort of policy outlook is. And, that could be positive or negative, right? Who knows what Burnham will come up with. And, for example, if all of these developers are sitting on large land banks, is there any policy risk, just thinking out loud, is there any policy risk these guys will be forced to release their land banks at a loss? Or is there a risk that some of these developers might be asked to subsidize the housing market?
Well,
They're good
so this
questions, aren't
this
they? They're good
this
questions.
this
But
thing of kind of land banks is really about kind of their output and how many things they can build and their sales per week and all these kind of metrics that house builders use it. So the idea that they sit on land and don't do anything with it is a kind of bit of a myth, really, to a point. I mean, they make money by selling the houses, and
Mm.
they'll look at what they're selling, and they've got the projections, which they've already gone over for this year, which was 17,700. They're projecting, I think it's 18,500 for next year. So they've already got it all lined up, and they are building them. The reality is, if the government did want to start taking land off them to make them build, who's going to build it?
exactly,
Because
exactly.
and that's who it is. I mean, these are the people that can build it. There aren't people don't have the infrastructure to go around. The likes of SME builders like or developers like me wouldn't be able to do it. And so you do need those kind of big boys to be able to do that. Maybe they could do some partnerships. I think is what Adam was kind of alluding to there, public-private partnerships, which would be sensible. But again, I struggle. I get the kind of political point of view of doing that, but I think in practice it's almost impossible, really,
Mm.
to do it. So
I think
yeah.
you'd need someone to the left of Jeremy Corbyn and John McDonnell to sort of implement the things that you've just said. I think they're good challenges to raise, but with the form that Burnham has got with cross-sector, cross-party work, and that is easier when you're a mayor. I know, but it can't afford to alienate these guys ultimately.
Well, I don't even think it's about, you mentioned implement there. I don't think you can implement it. That's kind of what
No.
my point is. I think you can say, hey, we're going to do this, but it can't be implemented. And that I think is the problem we've got in the country in terms of kind of you would, I mean, who would build it? You wouldn't be able to do it. And so yeah, it would end up costing a fortune. It would cost the taxpayers a fortune. Um, yeah,
It's kind of semi-nationalizing them, isn't it,
yeah,
to an
yeah.
extent? And that would be maybe a
But
step too far. But
I mean, they've tried to do that with several local authorities, haven't they? Croydon had a house builder, several other local authorities had house builders. They all went bust. The only ones that managed to do it were ones that did public-private partnerships. Even then, a lot of them went bust, but some did make it. So I do think I think it's an important point to make, because I do think lots of people kind of have that view, but
mm,
the reality of getting it done is just very, very difficult.
mm.
So it'll be interesting to see. But yeah, I think it's a good point. Okay, Adam, what's your pick?
Super. So I've gone for a gilt, a low coupon gilt, long dated one. So TG 61, 61 being the year of maturity. Currently sort of sitting about the 5.4% yield range. And it's, although, why such a long duration? It is there as I actually think over the next 12 months, the long dated yields are going to start to come back down a little bit. And I think, again, trying to reinforce the point about asymmetric bets, I think there's a potentially big upside here if something does go wrong. So if you were to listen to the Nigel Farage stick, let's say, or Liam Halligan, his favoured economist on the right, he would tell you as soon as Miliband is the Chancellor, who's the betting favourite ultimately to be the next Chancellor, the gilt yields are going to go into meltdown and there's going to be this tax and spend budget and blah, blah, blah. And look, I'm deeply uncomfortable with, I think the zealotry point around Ed is right. I think he's too far on the net zero bus. I do think he was the wrong brother and all the rest of it. But I will say, I was lucky enough in 2013 to go to the CBI conference. And I watched Miliband and Cameron both speak. And he was a seriously impressive individual. No notes, off the cuff. He delivered probably the best speech I've ever seen. So my point is, he's got the intellectual firepower and capacity to do this job. It is a straitjacket at the moment with where the bond markets are. And I think he's being priced in as more of a moron than he is. The other asymmetric side to this bet is he doesn't get the job and Pat McFadden does, in which case I think the gilt yields automatically come down. So I'm not saying we're buying it to sell it next week, but I think 5.4%. We've got the wind behind us at 5.4% yields.
So you think? Can I just clarify to see if I've got
Yeah,
this right? You think the
yeah,
gilt yields are for this gilt is at 5.4
yeah.
because the markets feel that Ed Miliband is going to become chancellor and they have over-egged how much of a wally he is, and you think he's not as much of a wally as they think. So once he does get in, they'll realize he's not as silly as maybe they thought, and the gilts will come down. Or Pat McFadden gets in and they'll be happier, and then they come
Yeah,
down.
I
Is
think
that
I
right?
think McFadden is the immediate impact. Miliband will have to wait for a budget, probably, to be honest. But 35 years, 5.4%, no effort, no risk. That sounds okay to me, Rod, at the moment, to be honest. So yeah, it's definitely a wager. It's similar but different to Manish's, I think, and very UK specific. But if there is any of that demand destruction we talked about, you could be on a big winner here. I don't see a huge downside. I do see a small probability of a big upside.
So I guess my question is the same one as Manish. What would have to happen for you to feel the opposite way?
What would have to happen? The wrong chap, Miliband, gets
Miliband
elected.
is as much of a wally as they think.
Yeah, he starts making the completely wrong noises about what we're going to do. There's tweaks to the fiscal rules that are sort of push the boundaries of the chat. You know, it's like, for example, you could change what critical infrastructure is defined as. I actually would do that if I was the chancellor, to be honest, but that's a different conversation. But he could do that with something silly like on the basis of net zero and say, look, this is all critical infrastructure. We're going to borrow an extra 250 billion before 2050 or more. You know, we need more than that if we're going to go for some of the plans that have been talked about. And it's not going to have a good business case to be a good investment in the economy. So that sort of thing. Ed looks more like a Liz Truss style character. That would be definitely time to change the mind, Rod.
I'm not as positive about Ed Miliband as you are, but I haven't seen him speak, so I don't have as much intel as you. Manish, what are your thoughts?
Yeah, two positives and two potential risks. So two positives, similar to gold, actually. There are two big asset classes which anytime there's a crisis, these two asset classes do well, and that's gold and government bonds, right? So this kind of fits in very much like gold in terms of protection for your portfolio. So that will definitely benefit from any kind of crisis or any issue in the world. So that's one thing. The other thing is there's a lot priced in, right? There's a lot of fear priced in with Ed Miliband or whoever, Burnham. So there's a lot priced in. So that could be asymmetric, as Adam rightly said. So those are the two positives. The risks are it's very long duration. So, longer duration bonds are much more sensitive to two things, inflation and interest rates. So if either of those two kind of shoot up, then yeah, they will long bonds underperform. So those are the two major risks. And the second risk or second potential downside with owning long dated bonds is that if all you did was own a 2-year bond, you're getting something like 4.25, 4.3%. So to take on that additional duration risk, you're getting a pickup of, to some people, that might be a good pickup of 1.5% or something. And some people might think, well, that's not really worth it because I'm taking all that duration risk, but I'm only getting an additional 1.5% over and above my 2-year bond. So those are the things I would say. I'd be, yeah,
When you
two
say it like
positives, two risks.
when you say it like 1.25, it does sound a bit rubbish, but it's more than that. It's like a 20% increase, isn't it?
Yeah, and
When you look at it
and for
like
the
that.
big pension funds and the institutional funds, for them that
Yeah.
is huge, right? Because if they're liability matching, for them that can be quite significant. But for the ordinary retail investor, it's probably not much. And actually, if you think about, I'm a big believer in inflation being understated, the official rates of inflation being understated. So if you think that actually the reality rate of inflation might be more like 5, 6, 7, then it's barely covering inflation if you look at it from that perspective.
Mhm.
But I think short term, I don't think you're not planning to hold this until 2061 anyway, are you, Adam? So this is more of
Oh,
a
that's right. That's right. And of
this is
course,
more of a
remember,
technical.
we're going to get no CGT when we make a big profit on these gents because
Yeah.
we got hold it in our personal name, right?
Mm.
So even if we go CGT to 40%, which is another thing we haven't talked about yet today, we're not going to pay any on that government bond. We're going to pay the income tax on the very modest 0.5% coupon that we're talking about. So there's another little hedge in there
Yeah.
for us as well, to an extent.
Yeah, exactly. And so all the risks I mentioned are assuming you hold it for the long term. But if you're doing it for the short term, based on all the good reasons you mentioned, Adam, I think it makes sense for the short term. Yeah. Lots
Brilliant. I
priced
think
in.
I think the only thing we haven't then probably covered is that also I think we're going to see a summer of speculation once again over taxes in the property market specifically, again, because the land value tax is going to be discussed. I broadly agree with what Rod's points were around that, very much so. There are some positives to read out of it. But once again, remember one of the best phrases I ever heard in trading: buy the rumor, sell the fact, folks. There could be some deals around this summer when people are looking about. If you're trying to sell some expensive houses, good luck, because it didn't help the market last time out. And now we'll have a new suite of idiots. Sorry, well-meaning politicians to make the same mistakes that the last lot have made, who make the same mistakes as the last lot before them.
Yeah. So it's going to be sell the rumor and buy the fact in this case.
There you go.
Very good.
Brilliant. Well, thank you both. And hopefully we will be back much sooner than the last gap for our next quarter. But yeah, until next time, thank you very much.